Have you ever wondered how some investors make money when the stock market goes down? Or what does it mean to short sell a stock and why is it so controversial? If yes, I recommend watching this video first, then circle back on this episode so you would understand some of the topics here. Moving on, short selling is one of the most misunderstood and risky strategies in the financial world. It can lead to huge profits or massive losses, depending on how the market moves. It can also have significant impact on the economy, the companies, and the investors involved. In this episode, we will try to answer 10 of the most common questions about this fascinating and complex topic. And so, without me rambling on, hi, welcome to Rogue Sector. Tara, let's get to it. Number 1. How much collateral should I have in my trading account if I want to short sell stock? This can vary from one broker to another. This can be 102 to as high as 150% of the current price of the stock. In general, collateral in short selling is in the form of cash deposited in your trading app. The collateral serves as the borrower's guarantee in case of default or as buffer in times of wild price fluctuation. Number 2. Isn't it a form of gambling? Well, this depends on your definition or opinion of what gambling is. Betting on slot machine and relay don't give you the advantage of calculated risk. When you short a stock, you have this option. When you cross the street to get to work, you risk being run over by a bus, but you mitigate this risk by following the traffic lights and crossing on the pedestrian lane. Practice due diligence and take calculated risk, because if you don't, then life itself easily fits under a gambling category. Let's head on to number 3. Isn't it legal? Short selling is legal in most countries with advanced stock market exchanges. After the 2008 financial crisis and the recent COVID pandemic, regulators have adopted rules allowing them to issue a temporary ban on short selling in times of crisis. Naked shorting have also been prohibited, then the uptick rule was adopted. Check with your stock market regulator to ensure that you're within legal bounds when you short a stock. Number 4. What is short squeeze? ChatGPT says a short squeeze is a phenomenon that occurs when a stock's price rises sharply, forcing traders who bet its price would fall to buy it to avoid greater losses. Short sellers borrow shares of an asset that they believe will drop in price in order to buy them after they fall. Suppose these short sellers open a short sell position here, since the chart seems to be heading down. After a few hours, a group of people decided to take a long position, which caused an upward spike in the stock price. Here is where the point of short squeezing begins. As more people open a long position, the brokers of these short sellers may start making margin calls, forcing them to add more funds in their account or risk getting their position closed. On the other side, short sellers continue to lose capital as the price of the stock continues to go up. Now, if these short sellers decide to close out their position, they would lose capital. However, if they decide to keep it open, fees are going to start to pile up. Now, this is just the initial squeeze. To make things worse, every short seller that exits the trade becomes a buyer, further pushing the price upward and leaving the rest of the short sellers in an even deeper hole. This also creates a squeeze within the short sellers themselves. And this is how they get squeezed out from every direction. Number 5. What is naked short selling? This Disney character comes to mind when I think about naked short selling. Well, because shorting is a bearish sentiment and he doesn't have shorts and he's, well, naked. So there. Anyway, before we get off topic, naked short selling involves selling shares that have not been borrowed or confirmed to exist. There are multiple ways to do this, but we'll take another video to tackle them all. Let's discuss what happened to the company GameStop, which at some point was shorted by 150% of its total outstanding shares. This loophole exists because of weak inventory and monitoring of shares. The 2 to 3 day order settlement, that did not help as well. If no one oversees these transactions as they happen, then people may continue to buy and sell shares that's already been loaned without them even knowing it. And this creates two things. One, extreme downward pressure to the price of the stock, and two, Unsettled trades because there is no actual stock to be exchanged. Some regulators have banned this practice in whole or in part, but I think this is just a band-aid solution. A more robust monitoring of shares is what's needed, otherwise, anyone can fall victim to this. Let me know what you think about this in the comment section. Number 6. What is an uptick rule? It is a rule that prevents execution of short sell orders in succession. Here, the next short sell order will only be executed if there is a recent upward movement in the price of the stock. Its aim is to prevent the stock price from spiraling down. This also gives investors with long positions to exit before the downward trend continues. The trading algorithm takes care of executing this protocol. Some exchanges apply this provision only if the stock falls 10% within the day. Number 7. How will it affect me as a long-term investor? As a long-term investor, short selling can temporarily impact your holdings. If you own shares of the company being shorted, you may experience a decline in the value of your shares. Do research about a company and ask yourself if your reasons for buying the stocks then still hold true today. There may be valid reasons why people are shorting the stock, and you have to see that standpoint too. However, if you're not invested in the company being shorted, then it won't directly affect you, and you may enjoy your coffee with your pal right there. Number 8. Do I get something in return for having my shares loaned out? Yes, according to Investopedia, yes. Holders of securities that are loaned receive a rebate from their brokerage. However, I have been an investor for years now, and I haven't received any form of rebate that says they were from loaning my shares. Maybe I'm just not lucky enough to have my shares loaned out by my broker. Number 9. What about the dividends? What happens to them? Yes, about that. It is important to understand the term record date. Simply put, it is when companies checks for who owns their stocks so they can distribute the dividends to them. If you are in possession of the borrowed stock at the time of record date, you will have to remit the dividends to the lender. Number 10. How can short selling help in price discovery of a stock? Short selling can help in price discovery by exposing which companies' stock prices are too high. Short sellers conduct extensive research, and through this, they can discover accounting inconsistencies or other questionable practices in company. This enhances credibility of the market. I hope I was able to give clarity to one of the most intriguing aspects of stock trading. Please like and subscribe. And that's about it. Thank you for spending your time with me here at Rogue Sector, and I'll see you on the next episode.